Let me ask you something uncomfortable. If you suddenly had $20,000 sitting in your bank account, would that money change your life or quietly disappear within a year? Because here's the truth nobody warns you about. Saving your first $20,000 isn't the hardest part. Keeping it and multiplying it is. And the decisions you make in the first 2 weeks after hitting that number can determine whether you retire comfortably or start over from scratch. Let's talk about the financial crossroads most people don't even realize they're standing at. There's a strange psychological shift that happens when you hit a meaningful savings milestone. You feel accomplished, you feel ahead, you feel like you've earned an upgrade. Suddenly, the apartment feels small, the car feels outdated, the vacation you postponed for years feels justified. Your brain starts negotiating. I've worked hard, I deserve something. And that whisper is where wealth quietly dies. Not because people are reckless, not because they're unintelligent, but because money decisions are emotional long before they're mathematical. This is where most people unknowingly sabotage their financial future. Before you even think about investing, there's one question. Are you paying more in interest than you could realistically earn investing? Imagine this. You have $8,000 on a credit card charging 20% interest. At the same time, you're excited to invest that same $8,000 hoping for a 9 to 10% return. That's not investing. That's swimming upstream in a hurricane. High-interest debt compounds against you. Every month it grows while you sleep. Paying off debt with 18 to 25% interest is like earning a guaranteed 18 to 25% return. You will not consistently beat that in the market. So before you try to grow money, stop the bleeding. Rule of thumb: anything above 6 to 7% interest deserves serious attention before investing aggressively. Here's where people get impatient. They clear debt, they feel powerful, they want momentum. So they invest everything. Big mistake. Because life doesn't schedule emergencies around market cycles. Car repairs, medical bills, sudden job loss, family obligations. If your money is fully invested and something breaks, you're forced to sell investments at the worst possible time, use credit cards again, or panic. An emergency fund isn't about returns. It's about stability. If you're single with steady income, aim for 3 months of essentials. If you have dependents or variable income, 6 months minimum. It's not lazy money, it's financial armor, and armor keeps you in the game long enough to win. Now we build tax-advantaged investing. Once debt is handled and your emergency cushion is in place, now the real compounding begins. This is where boring becomes powerful. Instead of hunting the next big stock, think system over speculation. A retirement account like a Roth IRA allows your investments to grow without future tax drag. That's enormous over decades. Let's simplify. If you invest $7,000 in your 20s and earn roughly 8 to 10% annually, that single contribution can grow into hundreds of thousands over time. Now multiply that by consistent yearly contributions. That's not hype, that's math meeting patience. Here's a hard truth. Most people lose money trying to outsmart the market. They chase trending stocks, hot crypto tips, day trading strategies, or insider advice from social media. But markets reward discipline, not excitement. Broad index funds, which simply track large portions of the market, have historically delivered steady long-term growth. They aren't flashy, they aren't dramatic, they don't make headlines, and that's exactly why they work. Trying to jump in and out of markets often means missing the best recovery days, which tend to happen right after the worst crashes. The investors who win are not geniuses, they're consistent. The real wealth killer is lifestyle inflation. This one's subtle. You hit $20,000 saved, you feel elevated, you upgrade your car payment by $350 per month. That doesn't feel like much, But over 30 years, that $350 invested monthly could grow into hundreds of thousands of dollars. Read that again. The upgrade didn't just cost you $350, it potentially cost you long-term freedom. And here's the kicker. In 3 years, the new car won't feel special anymore. Humans adapt quickly, which means you paid long-term compounding for short-term dopamine. That trade is rarely worth it. Other smart options, depending on your situation, money strategy isn't one size fits all. Depending on your goals, you might also consider treasury securities for short-term safety, real estate if you're comfortable managing property, or investing in yourself, certifications or skills that significantly increase income. If a $1,000 certification can increase your salary by $15,000 annually, that may outperform any stock investment. But be strategic. Only invest in skills that have a real demand and measurable upside. Here's a practical roadmap if you've saved $20,000. Step 1. Eliminate high-interest debt, over 7%. Step 2. Build a 3 to 6 month emergency fund in a high-yield savings account. Step 3. Max out tax-advantaged retirement accounts if eligible. Step 4. Invest remaining funds into broad, low-cost index funds. Step 5. Automate monthly investing, even small amounts. Step 6. Avoid lifestyle upgrades that reset your progress. Step 7. Stay invested. Don't try to time the market. Then do something radical. Stop obsessing. Let time work. Your first $20,000 is not a trophy. It's a test. It asks one question. Will you choose short-term validation or long-term freedom? Wealth rarely comes from dramatic moves. It comes from quiet consistency. The people who retire early aren't lucky. They're not necessarily higher earners. They simply resisted the urge to impress people today at the expense of themselves tomorrow. Be patient. Be disciplined. Be strategically boring. Because in the long run, boring money builds extraordinary lives. And the version of you 30 years from now, they're depending on the decisions you make this month.